The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I am Perry Sykes, and welcome to the Investor Resources podcast. Buffett just put out their quarterly letter, and he was saying, don't look for huge returns from Berkshire Hathaway ever again. We're going to try to be slightly better than an average U.S. company, and mainly we're going to try to not make the big mistake because we've just gotten too big. They're 900 billion. I didn't know they were that big. 900 billion Berkshire Hathaway is. It's like, holy smokes. And as he put it, there is no possibility of eye-popping performance. There's only a few companies in the U.S., as he puts it, that could even move the needle a little on Berkshire Hathaway, and everybody's looking at them already. And outside of the U.S., there is no one. So that's what they're looking at. And he was talking about how size is the enemy when you get that big. You just can't make enough to make any changes. And then he talked about Charlie Munger being the real architect of Berkshire Hathaway. He said, I ran the construction crews, but Charlie Munger was the architect. So it's don't be afraid to find somebody who's good at what they do and let them do it. In as far as investing goes, because it changed his life. He was stuck in the in his mindset from Benjamin Graham. He said Charlie Munger called it his cigar stub. He was a cigar stub investor. He would want to buy companies with one puff left in them. That was it. He'd go find an old cigar stub with one puff left. That's what he was looking for. And Munger was like, no. You can find a good value company that's got a long run to go. That's what we want. We don't want the one puffers anymore. And it really changed the way he looked at it. And they did pretty well. Since they opened somewhere in there, it says since 1964, Berkshire Hathaway has returned 4.4 million %. It's pretty good. The S&P 500 returned 31,233%. So they outperformed, but even Munger last year when he was still alive, he was saying, it's funny, we get the guys coming through here all the time to watch us fish. They're watching us fish and they're seeing what we're trying to catch and they're checking out what we're using for bait. And we keep telling them, there's not many fish here anymore. You should go where the fish are. And it's not here. If you're buying big value investing, that's not where returns are right now. But that's what we do. And they're not going to change that. They're going to be very defensive, but that's not where the big returns are. So,
well, it's interesting that he did say did have in his report, what you referenced, that they are not going to provide any eye-popping returns in the future. And part of this is a function of the changes in the marketplace and the way investors work. What Munger and Buffett did was research companies looking for unique opportunities according to their criteria. The problem with the industry today is index investing.
Sure.
Munger and Buffett were researchers. They studied stuff and they made decisions. They were active managers. And yet today, one of the reasons he says that you're not going to get eye-popping returns is nobody is doing the research, and where the opportunities are, they've pretty well been picked over. It's kind of like going fishing and paying to use your bait in somebody's pond, and it's not feeding time. And so it doesn't matter how much bait you throw in the pond, none of those fish are going to bite. And that's part of the problem here. Investors think, well, Buffett's got this thing nailed, we'll just buy it and hang on to it. But he himself has said, we got periods of time where it makes no sense. These things, But we are long-term investors, and clearly, when you're nearly 100, you are a long-term investor. And if that's, maybe
Correct.
that's your lifespan. But when you turn around and look at what's actually going on in the financial services industry, start young and buy the S&P 500, which basically is don't worry about doing any research. Don't think about what you're doing. Just pile your
Right.
money into the market. Up or down doesn't matter. Well, it does matter, as is evidence between the differential in return between the S&P and Berkshire Hathaway. But they're doing the research. Are you? Most
And
managers today aren't.
yeah, and he said that's changed. That part of it's changed too. He said, if I ever made a mistake, and like you said, and I've made plenty, I've missed companies I should have purchased and didn't, but there was always something else coming along. It's not true anymore. He said, now the things that we're looking for, what we need, there's a handful of companies we're looking. There's not another great idea coming right down the pipe, and if there is, it's coming out of somewhere so fast it's like a lightning strike. You can't take your time and look at it and research it and look at the fundamentals and watch it run for a little bit and then decide to get in. It's just like Nvidia, and Nvidia accidentally becomes the biggest chip company on earth in the history of humanity, not because they studied and scoped it out. All of a sudden the technology became available that they happened to fit. And now they're doing an excellent job of making that run last longer. But that was nothing they did. They fell into that face first and said, "Oh wow, look at this. This is going to be great. This
Yeah,
is
but
going to
that's
be
not anything that
fantastic."
Buffett. That's not anything that Buffett was going to be buying. I mean, my goodness, you've got a
Nope.
30 times earnings, forward earnings. I mean, but it does raise a question if you're going to be in tech at 30 times earnings, you want to own Nvidia or Intel, which is also 30 times earnings, but hasn't done nearly as well. I mean,
Right.
they're playing
Right.
catch up all the time. But as far as investors are concerned, trying to figure out how to make money in the market requires work. Well,
Yes.
that's something that a lot of the younger generation are accused by employers of not wanting to do. They want
Right.
an easy ride. This is my first job. I want 100,000, 2 weeks off. I want paid benefits. I'm in a private office. And what do you mean you're not? What do you mean minimum wage?
Yeah.
Okay,
You must be kidding me. And
that's
they
kind of
got they
like
got that
every.
in investing too. They come along in investing. I want an easy way to do this. Robinhood said, I can do that. I'll put this on your phone. It'll look just like a video game. It'll be great. They came in droves. They couldn't invest fast enough when they couldn't go to work and somebody was sending them a check that they didn't have to work for. It was great. But that went away pretty quick when they found out, oh, I see. You can lose money doing this too. If you really know nothing, you can lose the money and you don't even know why. It's just gone. And it's really gone. What do you know? Huh, okay. I I learned something beside myself. So
You raised two other issues. The meme investors from the COVID period, they aren't all
yeah.
gone. Some of them come back. And what's interesting with regard to the technical side of watching what goes on in the market, some of those meme stocks will run as much as 28 or 30, 35% of the daily
Yep.
volume on the New York Stock Exchange. Because one of the technical things of looking at
Imagine.
is, do I want to buy this? Is there enough volume in it? And you say, well, what's generating a quarter to a third of today's volume? And you look at it and find out it is a 4-cent stock.
Yeah.
And it's up
Right.
50% today. Well, that attracts a lot of those Robinhood investors. And so it goes from 4 cents to 6 cents. But there's a phenomenal number of stocks that are on the mark, particularly on the NASDAQ, that trade for less than $1. And that's a lot of the volume activity with inexperienced investors, which are just basically
Amazing.
gambling. That's what
Correct.
Robinhood was set up to replicate, was a gambling environment. That's not investing. That's not process. That's betting, having fun, throwing a dart at your screen for all practical purposes.
Right. At best, they're trading headlines saying, "Hey, this is really popular. I think I'm gonna buy some of it," and that can be just a terrible decision to make in the investment world. That's just not enough. You need more data before you can commit funds.
Well, a lot of the stocks that these people are trading happen to be close to being delisted. So this weekend, when I'm doing some research, I found, and I don't remember the names of the stocks because I'm not going to follow them, but one of them is going
Right.
to have an 80-for-1 reverse split to get its
Oh my.
price back up above $1.
Right. There you
And it's
go.
from its high.
Wow.
It's already had two reverse splits in the last 3 years. And so it's fallen 99.9%, and they're going to do another 80-to-1 reverse split so that NASDAQ doesn't delist them and they go to the pink sheets. I mean, pay attention to what you're actually investing in. One, we need to know, does it have legitimate follow through? Is it a magnet for legitimate investor money? A product that
There you go.
works in an industry that's working where there's leadership in terms of returns? Well, right now, that's been dominated by technology, consumer discretionary spending. As we look at what's going on in the war and maybe the market kind of slowing down, you have a shift to some more defensive things like utilities or industrials and healthcare that do better in slower economic times. Those all have to be something that you pay attention to on an ongoing basis. Because when leadership changes, if you don't adapt to that leadership adjustment, you can spend years. I'll use a religious term. You can spend years in purgatory waiting
There
for
you
your
go.
investment to get back to even. You
Sure.
don't want to do that because that undermines the assumption that you're going to earn 8 to 10% a year. That assumption's not valid if you aren't an active investor paying attention. Doesn't mean you're trading all the time, but you have a set of rules and guidelines and you've studied and taken some training and you have some software that alerts you to these changes. And if you're not doing that, then abandon your assumption for retirement with a big account because you can't save enough to get there on just long-term averages. Unless, like
Not if you're
Charlie
giving it
Munger,
away. Yeah.
if you live to be
Security,
100.
security of time. You end up making bad decisions. You really do have to. There's no option to taking a look to say if I love this company, I love the story. Are they making any money? What do the earnings look like? I mean, are they really do they really have a product or a process that someone else is paying them for? And you have to get to that point, and that's how you find the companies that are really attracting money because you can look at them on a fundamental basis and say, okay, this is a real company doing real business, and that's something that we can follow. That means we have a chance here for this company as long as it doesn't make a huge mistake to make a better run. And you can identify whole sectors that say, okay, this sector is doing very well. And you can buy an ETF that'll reflect that sector, and you can go with that. But it needs to be real data, real earnings, real money, and attracting a real capital. That affects the price, and that's what you can really look at and get a good handle on. This is probably going to be a good place to invest in for now. You always have to be ready to pull the plug. Never get comfortable with being invested in anything. Nothing should be in your portfolio forever, only until it begins to deteriorate, and then you need to move on, look for something else.
Well, one of the other active monitoring that must be done is what happens with interest rates. Even
Oh,
in
sure.
the Berkshire annual report, Warren wrote that interest rates made a big difference in their returns. He understood the impact of interest rates. And so some of the phenomenal returns were having done the right thing in the right environment. And that's
Right.
one of the reasons why it's difficult to find better bargains today. One, he's looking at large company value positioning in a much higher interest rate environment. Well, that makes value harder to find because you can go put the money to work in a bond position for a limited period of time and replicate the return that might be available from taking what otherwise would be a high risk position because the company is cheap compared to the other stuff that makes no sense. But that
Correct.
doesn't mean it makes sense to even buy the cheaper one if it's not properly positioned and you can't buy it at the proper price. And that's one of Buffett's strengths. With all the cash he's had, when he's gone out and made a purchase, he's been able to negotiate private transactions. He's not going to the market to get something from John Doe because he
Right.
can't buy enough shares from John Doe. He would change the market. He goes to the company and talks to them, and he says, I want to buy a position in your company. He gets a private deal. Generally, he's doing that because he gets a very discounted price. That's also helped his returns, something that you and I can't replicate.
We can't do that. We're not sitting on, they're sitting on $167 billion right now. So they have a large amount of cash where they can go out and do that. And that's when you get the good deal. That's when, no matter what time of the day or night is, they answer the phone when you're calling. So they're gonna talk to you about, okay, you want to talk to us? We'll talk to you about that. And so you get a better deal. He's in that position, and it's a double-edged sword. They have to have those because they're buying such huge positions in such enormous companies. It's really hard to get a decent return when you're buying things that literally everyone else on earth is also buying.
I think we've pretty well covered all the major points that we were looking at when we started today.
I think we did.
We'll call that a wrap. You want to talk to us about how to manage a portfolio, what we use? I mean, we're open about how we go about our process and the software we use for tracking. And if you're trying to figure out how to do this, or even if you don't want to do it, you want to talk to us about how we would do it for you, give us a call, send us an email. We'll be glad to spend some time with you. Subscribe to our podcast. You'll get the next update when we get it done. Have a great day.